Hey folks, it is Sunday, October 2nd, 2022. I'm your host, Robin Lin, and welcome to Zoom Out with TouTzuSays. Today I'll be sharing with you my Q4 outlook, and hopefully we'll gain some insight into what's going on in the markets and help you with your investing. So let's get started. First, disclaimers. Please read through. Basically, short form is, again, I am biased. I have blind spots. This is for your entertainment only, and this is not investment advice, just for your thinking and entertainment. So I'm going to go through a lot of stuff today. I'm going to go through inflation, liquidity, geopolitics, and my crystal ball. Let's start with a recap. Here's a chart of January to September 12th, 2022. So we see in January, we started up high. We had the Ukraine war, a little surprise bump, and then almost a straight shot down into the July bottom. After the July bottom, a lot of people were speculating that, hey, is that the real bottom? Is that where it is? Do we go up from here? The war is known, a lot of policies are in place, et cetera, et cetera. Many people were thinking that was the bottom. So in July and August, we had a nice, healthy rally. And then in the middle of August, we started to come back down, and then we bounced back up. So was July the bottom? Almost equally split in Wall Street. Some said buy the dip. Others said, no, there's more to fall. Even when we look at the charts, almost no use. For the bulls, comparing to 1962 charts or 2015 charts, extremely high correlation that the market wants to keep going up. For the bears, also compared to 2008 or 1973, extremely high correlation to those charts, and they believe, no, the market's going down. So what actually happened with stocks after the 16th? Well, the S&P fell all the way down. So it's like the worst month since March 2022. In the month of September, the S&P 500 fell over 9%. This is 3 consecutive quarters of a down S&P. So we haven't had that in a long time. The last time we had it was in 2008 with the great financial crisis. Now, looking towards the end of September, we can see that, yes, the market at this inflection point actually did not go up. It went down. And we're hitting the 200-week moving average, this red line, which is a very critical line for technical traders. This is where all the algorithms and the computer trading programs have set a level of, if we can bounce off of that, it's good. If we fall through that, we might be going further down. So for the year so far, the S&P 500 is down almost 25%. The NASDAQ tech stocks down almost 32.5%. It's a pretty bad year. When we look back and see the month of September, energy also fell almost 10%, but net for the whole year, energy is the only sector that is positive. So just to keep that in mind, almost no matter what you invested in, unless you had energy, you were toast. You were feeling a lot of pain. This is a very important chart in a wonky sense, so most of us don't pay attention, but the dark purple is treasury bonds, and longer-term treasury bonds. And the gray is the S&P 500, the stock market. Typically, when the stock markets drop significantly, the bonds, longer-term treasury bonds, tend to do much better. So they either outperform or at least drop a lot less than the stock market. Except this time. This time, the bond market dropped almost 30% when the stock market dropped 25%. This is unprecedented. This is really weird. This is historic. So keep this in mind. There's a reason this happened, but what is that reason? I think a lot of people on Wall Street are still struggling to figure this out. So a quick recap from my June outlook. I expected inflation, high prices to persist well into 2023. that would cause bankruptcies, unemployment would rise, economies will stall out or go into recession, social unrest increasing as scarcity economics created socioeconomic tensions. I also forecasted that the Ukraine war would be a long war. It wouldn't be over easily. It wouldn't be negotiated quickly because, for one, despite all the military issues that Russia has faced, their real power is in the fact that they're the largest commodity exporter in the world. And the longer this goes through and the worse this winter is, the more leverage Putin has in getting his way. So I think that he will try to tough it out all the way into next year, especially this winter, and see what breaks and where he can step in to negotiate. Commodity scarcity should persist. National security spending would go up. I think the world is in a deglobalization phase as everybody now focuses on self-preservation and trying to figure out what to do internally and externally. So how did we do? I think we did pretty okay. We still have persistent and high inflation. It came down from 9.1 to 8.5-ish for headline inflation. Interest rates are rising and they will likely continue to rise with the latest Fed increases. Unprecedented levels of the Fed rate hikes. They did a 0.75, 0.75, and in September, another 0.75. And so now we're at 3.25% the Fed fund rate. And they just announced that they're likely to keep going as inflation, as I mentioned, is still very high. And interestingly, unemployment has risen, but it has not risen at a really fast pace where they need to worry about people losing their jobs. So bankruptcies, I have a little clock here. I'm saying this needs more time. I think that next year, Q1, we're going to see some real fireworks. A lot of companies are struggling. They had the summer bump, and now they're trying to figure out if they can survive longer. I think we're going to see some issues come Q1, Q2 next year. Clearly, global economics have slowed. Europe has slowed. The US has slowed. We've had Q1, Q2, both as negative GDP readings. Q3 would come out fairly soon. Very interesting. We'll see how that goes. Currently, the Atlanta Fed is predicting something higher, but then a week ago, they thought it was basically near zero. Downward revision of earnings, social unrest, defense spending. It's a long moral stalemate. Commodity scarcity. I recommended holding more cash in June. I think these have all turned out fairly correct. The Russian ag export restricted. I assumed that they wouldn't be able to export, but it looks like they have been permitted to export following Russian rules and getting paid in rubles. So that was an error in my forecast. So anyways, so what should we do now? How do we look forward and figure out what we should do? I think the key considerations are inflation, liquidity, and geopolitical risk. So let's go through each of these in more detail. Inflation, when you break it down, there's the core inflation and there's headline inflation. Headline is where there's energy and food prices that are in our day-to-day expenses. However, the Fed and central banks tend to focus more on the core inflation, which is slower moving and it is not as volatile because energy prices can spike up for a quarter and then go back down. So this is their preferred method of deciding what to do with inflation. I think an important component of this inflation element is also how the labor markets are looking and whether or not there's demand destruction because of more people being unemployed, et cetera, et cetera. So back in early, springtime, gas prices were shooting up. And this is probably the most obvious way that Americans figure out that there's inflation. We see the price of gas shooting up, keeps going up for a long time. We feel the pain and we're like, oh, shoot, there's inflation. We got to do something about it. Well, I think what we've seen is President Biden did do something about it. We have the Strategic Petroleum Reserve and he authorized using that reserve to basically boost the supply of crude oil in the US. And because of that, our gasoline prices have come down significantly. So that has helped. Now it's in October, there's a month to elections. It's helping Americans feel like maybe inflation isn't out of control. Maybe they feel okay with the current administration. So because of this decline in oil, gasoline prices, many assumed that inflation would start to fall as well. Here is the latest breakdown from August. And here, again, it's broken down to headline inflation, core inflation. Yeah, it came down, but not as much as you would think. Food prices are still going up. The energy prices did come down, as I just showed you. But what's happened is the core inflation components actually went up. Yeah, car sales and everything have slowed significantly, and that probably will continue to be something that is deflationary, bring down inflation. But shelter prices, which make up 32% of the calculation, those have been going up steadily. And this is a very slow moving and high impact inflation component. And there's reasons to believe that this is going to keep going up for another 3 to 6 months. Other places where we're seeing inflation makes sense, service inflation, because the cost of wages and the cost of goods have all gone up. So all of these prices have been moving up as well. Here is a chart that indicates that the shelter prices, which tend to lag in the calculation, we're going to be seeing that 6%, 6.5% year over year increase. So that indicates that for the rest of this year, we're probably still going to see shelter prices being a very relatively high, and because it's such a huge component of the inflation calculation, we will probably see inflation not coming down that fast. Other components, but health insurance and medical insurance and those services keep going up. Nationwide, rents did finally fall in August, but 0.1%. I mean, yeah, that's just a blip, and it's a one statistical element. We need to see this continuing on before we see rent starting to impact the shelter prices. Now, getting to the other parts of inflation, still we are running oil inventories, global oil inventories, low, and their forecast, this is done probably a couple of weeks or a month ago, forecast is we are not going to see equilibrium until sometime mid next year. OPEC has been underproducing what they thought they would be producing. So this is a really weird situation. This has geopolitical impacts. There may be strategic reasons. There could be that, like I've mentioned before, Saudi Arabia has these massive oil fields that we measured and said there are X amount of reserves, but that data is 20, 30 years old, and there's been no public update. We have no idea, and it's not possible that they could be magically replenished all the time. They should be draining. So in any case, there's a lot of speculation that Saudi Arabian oil reserves and production really can't be that high for the long term. And OPEC is meeting next week, and they've already been indicating that, hey, oil prices have come down significantly. The world may be going into recession. We're going to actually start cutting 1 million barrels of production a day. Their goal obviously is to keep oil prices relatively high. And if they pull the trigger on this, October 5th is their day of making this decision, we'll probably see oil prices again start to ramp back up. So, and of course, Russia's grip on Europe because of natural gas is significant and long-term. Now, analysts are basically predicting that the gas shortages aren't going to go away until 2025. So Europe is faced with a massive energy crisis for several years. This will impact their economy and costs and et cetera, et cetera. This is a very sad thing to look at because you need energy for electricity, which powers homes and factories. Well, they're expecting that up to 20% of disposable income is now going to be needed for energy bills instead of, going out to dinner or buying a new car. Energy bills are sucking up extremely high proportion of the disposable income of Europeans. For the rest of the world and also for Europe, I wanted to remind you that, input prices into agriculture, when we want to grow crops, we need fuel, diesel to run the tractors. We need natural gas to dry out the grains. We need fertilizer to improve the productivity of the crops. We need natural gas to make fertilizer. I'm not sure about the coal, but it's in here. So anyways, those costs have all shot up significantly. And this is very important as it causes great stress for farmers. Now, looking at the US, 2/3 of the US is in drought conditions. And if you look here, 2020, the beginning of La Nina. So blue is no drought. Everything over here is drought. We had a second year of La Nina last year, which was, pretty exceptional. And now we're talking about possibly a third year of La Nina. I think some forecasters are saying that's an 80, 90% chance of a third year of La Nina, which is pretty rare. Bottom line is, it looks like it should be dry and drought-like again. That's feeding into specifically the US. We're still 75% in drought conditions at the end of September. These are estimates for ending stock of corn and soybeans. So in 2023, 2022, 2023, this crop, it's forecast to be less than last year and significantly less than, say, 2017 and 2019. Europe has been facing drought as well. You probably heard or seen some news about that. It's looking very bad. Germany has this main river that runs right through the country, and it's low, 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 and you're seeing these rocks show up. Some industrious ancient German carved that in, and basically it means something like, if you see these words, be prepared for famine. And that's a really bad situation. Even China has been facing extreme heat and drought, and every once in a while, when it does rain, it causes flooding. So China has been facing also drought-like conditions, and that's hurting their crops. European fertilizer industry, again, it's fed by natural gas. They can't produce ammonia without natural gas. So they're producing less ammonia, therefore they're using less fertilizer in their crops. Therefore, the yield on the crops is also falling. I'm not an expert in this field, but there's almost a one-to-one correlation of using fertilizer and improving the yields. So by slashing 40% of, let's say, fertilizer use, you're slashing 40% of grain production. Another look at world ending stocks, adding wheat to the picture. Again, less than the year before. Only soybeans is slightly higher, but everything else seems to be less. And rice feeds almost half of the world. I mean, most of Asia goes on rice. India has been facing challenges, so they've been restricting their exports. Italy is the main producer of rice in Europe. They're cutting back. Even in California, which produces about 20% of US rice, and specifically the yummy sushi rice that I love, they're facing serious drought conditions. And of the 550,000 acres that they use, 300,000 are not going to be producing. So in picture form, it looks like this. Last year and this year, the amount of crops that they can produce is significantly reduced. In China, as you may have heard my past talks about China, this slashed line left is desert. This is where they get enough rain to grow food. And this is where all the humans live. The dotted line, that's another line. This is where wheat is grown, and this is where rice is grown in China. And we're seeing pretty serious drought conditions in the south of China, which will impact their rice production. So, as I said, the odds of La Nina are up to 80-some% now. And it means that the Pacific Ocean is cooling, and it's creating different jet flows in the atmosphere, and that creates fairly predictable patterns. It looks like the Pacific Northwest is going to get good rain. It'll be cold, dry, and cold for the rest of the breadbasket of the US, which is a challenge for farmers because they need the snowfall here in the winter so that come spring, there's plenty of water to water and feed the crops. So it might not be there for next year's crop. Here's another look at La Nina patterns for a global look at how it affects different regions. As I said, it'll be dry here, and it turns out to be wet in this area during the December to February period. In the June to August, the summer times, it changes around. So, as all atmospheric things evolve, we have to keep that in mind. Hopefully we get some good weather out here. We don't have a picture here that says Europe, but basically when I looked it up, Europe is similar to North America, where it looks colder and drier. And because of the lack of crop production and high costs, we're seeing stress to all places all over the world that depend on imports of food. And on top of that, imports of cheap food. We've been producing so much that everybody's been able to do okay. This year looks really, really challenging. Next, let's talk a little bit about the U.S. labor market. And this is a conundrum. I mean, we hear of all the inflation issues, the economy slowing down, yet jobless claims have not been rising. People are not asking for unemployment benefits, which is really interesting. And it's a very weird question. Why is this the case? There's speculation that, okay, there's maybe 1 million people that have long COVID or just out of the labor force. There's speculation that boomers have just retired en masse, so they're out of the labor force, leaving a smaller labor force, and therefore the unemployment situation is is relatively low. Okay, so that could be one possible understanding of why this low jobless claims remains to be the case. And jobless claims is a weekly number that the federal government gets a notice, hey, I'm out of work, I need a benefit. So it's a very up-to-date and fairly reliable indicator of the labor market. So that's very interesting. When we look at it through the non-farm payroll, which is called the establishment survey also, this is the number that you hear. This is the unemployment number. So the unemployment number is really interesting. It said it went up last month, which is yay, good for the economy. The economy is still growing. But the household survey showed a drop. And what's the household survey? Well, why do they have two different kind of surveys? This is really an interesting thing that the Bureau of Labor Statistics accumulates and publishes every month. So long story short, the non-farm payroll just measures how many jobs are out there. And the household survey says, takes into account, how many people are out there working. And in that sense, people with multiple jobs, if I work at Starbucks and McDonald's, it shows up as 2 jobs in the establishment non-farm payroll survey. Whereas if I'm working 2 jobs, but I'm one person, that shows up better in the household survey. So it's confusing. I'm not an expert in this. What I'm trying to say is this is it's not the full picture. Whatever the unemployment number is that the government is talking about, it's much more nuanced than that. However, the non-farm payroll unemployment number is the one that is popularly known, and it's also the one that the Fed tends to use in making policy decisions. So if it's not an accurate picture of the actual labor situation, it doesn't matter. The Fed is going to be basing their thinking and their policy, their interest rates, off of the non-farm payroll numbers. So the household survey historically, statistically, tends to indicate that things are going to slow down for everything else. So we're going to see that probably develop in the next couple of months, that the actual non-farm payroll numbers start to rise as more people become unemployed. How does that impact consumer spending and the economy? Well, here's a really interesting look at shipping cost from Shanghai. They've just collapsed. I mean, anybody who was in business importing things from Asia, we all know that prices doubled, tripled for one container, and you couldn't do anything about it. You just had to order it and have to get it. Now they've come down so significantly and so rapidly that that's a pretty healthy indication that demand has just collapsed. I think there was anecdotally a note that, last year at this time, there were 127 container ships just parked outside the port of LA. And today, 1 year later, there's like 8. That makes sense in light of retail sales numbers. The retail sales in the US, July was revised down. And although August rose, but it rose by a 0.3% month-to-month level, which is really nothing, especially in light of the fact that inflation is at around 8%. So you do spend more, but then maybe you're buying less. So it's a very weak retail sale numbers. Similarly here, online stores, that e-commerce stores, you're starting to see little blips of slowdown. Where do they go? And what happens to the holiday season? Keep in mind that because of the market crash, because of house prices coming down, et cetera, the household net worth has come down significantly in 2022 for all Americans. And as a result, Americans have been using credit cards more, and they've been blowing through their savings more. The latest number I saw was around 3.5% savings rate in the US, which is really quite low. It doesn't leave buffer for any kind of emergencies. And surveys are indicating the same thing. 30% of Americans are now drawing more from their savings than usual. So it's likely that savings rates are coming down. Credit card use is going up. Wages did increase, but probably not enough to cover all of the inflation. And probably a lot of the summer rah, let's go travel, spend some money, we're finally out of COVID. That kind of spending is probably quite temporary. And going into Q4, what happens? Does that slow down significantly or not? So in summary, my inflation forecast, core PCE, shelter services, I think it's sticky and it remains fairly high. Headline inflation factors, food and energy, I think because of the tight markets, short supply and lack of new production of all the critical food and energy resources, I think they rebound actually. They came down for a while. The US Strategic Petroleum Reserve was brought down to a third of what it normally is. They can't bring it down further. So there's no stored reserve of oil that can help keep oil prices down. We're going to start seeing market effects and market prices on oil and natural gas. and they will definitely influence food prices in light of a possible La Nina 3.0 for this winter. The labor market is weakening. I think, though, that what's surprising is the unemployment rate is actually lower than expected, even though it's climbing. It's not climbing as fast as what I think a lot of people expected, including the Fed. And in that regard, it indicates to the Fed that they can continue to increase interest rates, slow down the economy, because it hasn't created a lot of job losses yet. And the demand destruction, we're looking at, the freight rates going down, consumer spending clearly slowing down, the global economic engines in all areas. This is Europe, this is the US, also China, and a lot of the emerging markets, they're all slowing down at the same time. So in past crises, we had maybe China doing well when the West wasn't, and vice versa. This time, everybody's slowing down at the same time. So this is quite a big issue going forward. I think CPI is going to remain above 7% by the end of the year. We are seeing demand destruction, and we might have a really lousy holiday, but we're not seeing that in inflation numbers now. We're going to see it after the holidays. We're going to see it Q1, Q2, where we're starting to see those things slow down and hopefully prices come down. And there are no major economies in the world that are growing in Q4, and likely probably not into Q1. And then we'll see what happens after that. Okay, so that's the inflation forecast. Let's look at liquidity. So this is a very, again, wonky, esoteric, financial world kind of word. What does it mean? It's really important. And I'm going to show you some of those things here. And then we're going to talk about the things that are going to influence liquidity going forward. So why does liquidity matter? Just understand that during the financial crisis, everybody did QE, quantitative easing, and they printed money out of thin air and threw it into the financial system. And when that happens, it creates more liquidity, quote unquote, and this liquidity gets out there somewhere. And for the most part, we've observed in the last 10 years, this extra liquidity has found its way not necessarily into the real economy. Our wages and inflation didn't actually go up, but almost every risk asset, be it bonds, stocks, cryptos, real estate, almost everything went up. Now that we're reversing the liquidity, you're starting to see the effects. This chart is basically trying to show you liquidity is highly correlated with the stock market, and it leads by about 6 months. So as liquidity, the blue line, goes that way, there's expectations that the black line, S&P, is going to go that way too. Okay, so that's a very important early indicator of challenges in at least the stock market in this picture. So quantitative tightening effect on stocks so far, again, fairly tightly correlated. We see this, this is specifically China's liquidity, but since China was the largest importer of commodities, it makes sense that tracking their liquidity might be an early indicator of where commodity prices go. And again, this chart is extremely messy, but overall fairly highly correlated, that as Chinese liquidity dries up, and we get a little bounce over here, commodity prices tend to follow, okay? And as liquidity dries up, this is, again, much more specific, but I just wanted to show you how this works in the financial world. The orange line, the European natural gas open interest, this is where people make bets on direction, okay? And so as collateral requirements got higher, less people made these bets on where the direction of natural gas would go. And as a result, when a lot of people are betting, it's a fairly stable price. It's less volatile. as we start to see less people in the market, buying hedges and things like that, the market gets extremely volatile and it shoots up and down in big chunks. And this is a clear sign of a lack of liquidity in a certain market, creating volatility. Oops. And so now we talk about specifically the Fed and the Central Bank of the United States. So September, they raised another 75 basis points, 0.75%. And more importantly, they gave us this dot plot chart, which they do every meeting, but it's really indicative of what all the board members are thinking and what they think is going to happen. So this is, speculation. This is everybody's speculation. Every dot is a vote. But the key point is the Fed now thinks they need to raise interest rates up to at least 4.5% in order to defeat inflation. So 6 months ago, it was much less. Now they're thinking, okay, we need to get up to 4.5%-ish in order to defeat inflation. And that is an indicator of, okay, it's only 2 months, 2 more meetings for the Fed for the rest of the year. There's one in November and one in December. How much are they going to have to raise in order to get to around 4.5%? So that's, again, early indicator of how aggressive they want to continue to be. The hikes this time are historic. The Fed has never raised interest rates as fast and as hard as they have in the last 6 months, in fact. So look at that. Look at that chart. It's amazing. So I want to put that in perspective so you know how motivated and how behind the curve the Fed feels they are. And given that inflation is still pretty high, up in the 8% range, they may have a long ways to go. Historically, the Fed fund rate always exceeds inflation rate. Okay. So this is now Wall Street speculating. The Fed probably needs to get into 5 or 6% range in order for them to say, okay, now we've slayed the inflation dragon. Inflation is below this, and now we can think about slowing down or turning around. Okay. So keep that in mind, that Wall Street economists, historians are thinking that we need to get not at the Fed terminal rate of 4.5 that they put on their dot chart, but up in the 5.5 to 6% range. Okay, this is the same thing, but just in numbers. The Fed has always ended up with the nominal rate being higher than the actual headline inflation rate. Okay. So in our case this time, and this is old data, inflation may slow down, but if it doesn't, the Fed's going to have to keep going. Here's also old data, but this is globally. Basically, everybody is hiking, and because this is old data, September data, you have to add the Eurozone has hiked. Japan has not hiked. China has hiked a little bit, et cetera, et cetera. So globally, all the central banks are raising interest rates, slowing the economies. Some are also draining liquidity from the system. Those that are super big and printed too much are now trying to drain a little bit. Okay, so horrible meme. If you enjoy the rate hikes, you're going to love it when QT kicks in. And what does QT mean? This is, again, we printed up so much money. It's in the balance sheet of the Fed. And what are they trying to do? They're kind of trying to bring it back down. So through the first financial crisis, the balance sheet in the Fed was about $1 trillion. And then 2008 happened. We ended up with around 4. We're trying to lower it. And then, oops, COVID happens. And then massive stimulus and lots of buying and lots of printing of money. Ooh, and we peaked out around 9 trillion. Okay. Now the Fed starts removing stimulus, and back in June they already started reducing their balance sheet. But this is the important part. This is the forecast for the next year. They said we're going to take out 95 billion a month. And that'll be of US Treasuries, of mortgage-backed securities, et cetera, But every month we're draining this from our balance sheet. We're letting them expire, we're blah, 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 we're selling them off, whatever it is that they're doing. They're trying to reduce the balance sheet. And this is draining liquidity from the financial system, okay? And that's what we've been talking about. And as you drain that, the amount of dollars floating around in the world, not just the US, that has been dropping precipitously. So we actually have a US dollar shortage going on around the world. This is extremely dangerous and stressful to countries that are not the US, okay? Here's a picture of all the G4 central banks. We're all cutting the balance sheets. We're all draining liquidity, some more than others. The US obviously is the biggest, but everybody is doing some measure of this to try to reduce liquidity in the system, hopefully also to tamp down inflation. But when you drain all that money from the system, credit impulse will fall. So, I used to have access to all this money, but now I don't have access to this money. Therefore, I have to be a lot more careful with my investments. Therefore, if you're not a sure thing, I don't want to lend to you. Okay, so this is what the global credit impulse is trying to indicate, that it's draining the liquidity. It's really boosting, lowering, how should I say? Boosting your risk awareness, and therefore lowering the amount that you're going to risk by lending to other people. Okay, and that plays into all sorts of things, because the credit markets in the US are now extremely high, and where do they go if there's a problem? Okay, this is where we're getting into where I was talking about bankruptcies happening. What if you can't make that next payment? What if this and that happens? What if you can't borrow from somebody else that you used to be able to borrow from, and you're caught in a cash crunch? What happens? Okay, that also happens to countries. So here's a massive chart looking at sovereign debts, okay, all over the world, and there's some stress in particular countries. Here are probably more immediate concerns, these countries, because as a sovereign country, they borrow money and they have to make payments every once in a while. So principal is where they have to pay it back, or interest is just the interest amount. They borrowed in US dollars, and that their currency is collapsing against a strong dollar means it's a double whammy. Where are they going to get, if they were supposed to make a 5% interest payment, well, because their currency collapsed 50%, ooh, that hurts. Where are they going to get the dollars to make that payment? And you see the timing of that is, towards this winter, October, November, December, January, February. This is going to be a spike in demand for money for them to be able to pay off this stuff. And if they don't get access to it, what happens? Is that a sovereign default? Does that country go bankrupt? We've seen Sri Lanka already have that default. We've seen Argentina have it a gazillion times over the last 50 years. It's not a completely unknown thing. It is horrible, though, as Sri Lanka defaults. The people suffer. They can't afford to buy energy and food, and they have to make do with whatever they can, create and grow in their own country. So watch out for this issue. This is a very interesting and possible trigger event for bigger things. So again, just another map of where a lot of this risk lies. Central America, South America, a lot of African countries, Middle Eastern countries. There's a lot of risk. With the interest rates going up, obviously, you probably have heard mortgage rates have gone up too. the latest I saw was that it even poked over 7% and then came back down. I think it's around 6.7% right now. Mortgage rates are high and mortgage applications are low. This is not good for the housing market. And you saw, I don't have the chart, but the first house prices coming down is just showing up, I think, in August. So it's starting. The home, that boom, that craziness that happened for the last few years, it's coming to a halt. This also means that builders don't build, and those guys hire a lot of people, and that will impact the unemployment numbers. This is a horrible picture in my mind. Luckily, in the US, we tend to use fixed mortgage rates, but a lot of the world, they only use floating mortgage rates. So when you look at that, you understand the stress that some countries are facing if their interest rates go up, their mortgage rates go up. That means their mortgage payments go up, and then double whammy, you have inflation plus higher mortgage rates, and usually those are bigger ticket items, a lot of money. That's very, very stressful for the average Joe. So these countries are facing more stress with their mortgage markets. And again, the US, Belgium, like one of the lowest in the world, but something to watch out for, because this will impact how central banks in those countries decide how they raise or lower interest rates, because this could cause widespread damage to a country very quickly. Okay. And don't forget, we are now having historic levels of global debt. This is only to 2020, but that doesn't matter. It's huge. 250, 300 billion trillion dollars of debt mixed as private and public. This is relevant because, again, like the mortgage rates, if they float like these, every month becomes even more painful. And the more debt you have, the more you have to pay it off. So raising interest rates has a significantly less impact if your debt levels are low. So if you've paid off your credit card and you have no mortgage in your house, who cares if interest rates go up that much? It doesn't really affect your day-to-day. But if you have a mortgage and it adjusts, and your credit cards are going, you don't pay them, and those are adjusting upwards, all of a sudden they all compile at the same time, and it causes things to break. So this is extremely concerning that we're at historic levels of debt globally, and by raising interest rates, it will cause things to break. Finally, you may have heard of this word, the inverted yield curve. I didn't want to show you a curve. I just wanted to show you hard numbers. These are US Treasury bills, bonds, and notes. So this is the 2-year US Treasury and the 30-year US Treasury. These are the yields if you buy one. And so a 2-year being at 4% while a 30-year is lower than the 4%. This is not healthy. This doesn't make sense. It should be the longer that you take a risk, you should get paid more for it. This is inverted in the sense that the Fed is raising interest rates, so these yields have to go up, but they influence the short ends more with the increased interest rates. The long end, they don't really have much control. This is more determined by the market, by Wall Street, by investors. And they are saying the outlook looks bad. I'd rather lock in 3.5% than take the risk to see if we go into deep recession or depression or something bad happens. So this is a very unhealthy, a very negative, and this is why an inverted yield curve has historically been very, very highly correlated with recession. So doesn't look good right now. And along those lines, the US dollar is just the only thing that is appreciating in the world. Against every other currency, every other major currency, the dollar is appreciating, everything else is depreciating. And these are the major big ones, right? This is the euro, the yen, the Chinese yuan. Look at the Japanese yen it's down 20%. That's incredible. For currencies to move that much is really rare. Turkey is down, the Turkey lira is down like 60, 70%, but that's not a major economy. It's not a major currency, similar to some other currencies around the world. But against these majors, this is extremely scary, extremely telling, and very, very worrisome for the world. Something similar, but this is inverted, but this is for the Asian currencies against the dollar. In Japan, it got so bad that they actually finally decided to intervene. I think it was last week or 2 weeks ago, they started talking and they started taking some actions to keep the yen from weakening to the 150 level. Okay, so they started to, historically, once in the 140 level, they start to do stuff. And now they're going to start to do stuff in hopes of arresting this decline. I mean, in a sense, it makes Japanese exports really cheap if you have dollars, but it makes everything that they import also extremely expensive because a lot of it you still need to use dollars to buy with. Okay. So in aggregate, there's a falling liquidity leads risk assets down. So I think we are still in the stage of falling liquidity. Therefore, I think risk assets on their own, they want to head down. Interest rates, they will probably continue to rise as inflation, if I'm correct, is still sticky. By the end of the year, it's still up around the 7% range. They need to continue to try to slay the inflation dragon. The balance sheet reduction is the second prong for the Fed to work on, and they have indicated, and they have not indicated otherwise, any slowdown. They want to reduce the balance sheet. They want to take out that liquidity. They want to drain the system from animal spirits and cause demand destruction. That's their way to get inflation lower. Okay. Outstanding debt levels are worrisome because we are historically at a high level. So every time we raise interest rate, we're creating a really negative effect for a lot of people. And there are a lot of people buzzing on Wall Street about something's going to break, something's going to break. Nobody knows exactly what's going to break, but something is likely to break. And it probably will be shocking and scary and cause a big market commotion. Oops. As I said, currencies, I think the currency wars are starting. Japan is finally stepped in and they're intervening. China is intervening. Does Europe intervene? Don't know, but they might want to. The UK pound also. Do they want to intervene? They might want to. In fact, they kind of did recently as their new prime minister issued a new budget and it was not well received and caused a lot of panic. So they eventually did. The Bank of England stepped in to shore that up a little bit. Point being, those are the major economy and major currencies. Those are going to probably color within certain lines, but once you go to the emerging market currencies, those numbers are, like I said, Turkey, Argentina, their currencies have collapsed 60, 70, 80%. Those create just scary shocks and they change policies and they make people really upset, and some people are going to suffer and there'll be unrest and violence associated with all of that. The longer that happens, the more likely that those issues bubble up to the top and become bigger. So watch this space. The currency space is actually extremely worrisome. In this regard, the worse the world gets, actually, the more attractive the dollar gets. So it's kind of a vicious cycle where if you have a hard time, then you buy dollars. and then goes up, and then you have a harder time, and then you have to buy more dollars. So I would expect the US dollar to remain very strong and on the uptrend well into 2023. Okay. So, and now here are the geopolitical issues that I'm looking at. Obviously, we've all heard that the Russians are losing, the Ukrainians are kicking butt. I heard a really interesting statistic that of all the weapons, let's say the West gave the Ukrainians 100 tanks. Well, what they did in Russia, they've taken over so much and so quickly of Russian equipment, they just doubled the amount of tanks they have. So they get an extra 100 Russian tanks. So this is a really shocking and serious, serious issue for Russia. And it's causing stress within Putin's sphere of influence. I think this one is particularly funny. This is his chief military guy, and he says this: if I was planning suicide, you would tell me, right, boss? If you follow the news, I mean, basically Putin allies have been dropping off left and right for years. Somebody falls in the sea, somebody falls out of a building, somebody jumps out of a building, somebody is actually even shot with a gun, et cetera, et cetera. The list is extremely long. If you look into it, it's quite stunning. It's very, very Hollywood and surreal, but it's really happening in Russia. I don't know if this is a good sign or a bad sign. I have no idea. I just know that internally, the things that we can't see from the West, there's a lot of stuff going on in the background, and that could show up at any time. We also know that, hey, the Nord Stream 1 and 2 pipelines that run from Russia to Germany, oops, somebody sabotaged it, blew them up. Luckily, they weren't flowing because Russia had stopped the pipeline earlier anyways. So there was gas in the pipelines, and somebody blew them up deliberately. Those were explosions, and very, very deliberately designed, according to the intelligence agencies. And now this is basically cutting Germany off from extra natural gas. Who did it? We may never know. There's a lot of speculation. But suffice it to say, everybody's pointing fingers and is causing great stress for Europe, and probably is going to cause great stress for Russia as well. And I think this geopolitical war of propaganda and influence, it's spilling everywhere. So anyways, with the cutoff in the Nord Stream pipeline, if they happen to have a warm winter, they're going to be okay, because they're up at 80-90% of gas storage heading into the winter. If it happens to be that they can't restore the pipeline and it's a cold winter, they're going to drain those reserves by the spring is the forecast here. So very, very stressful for Europe. And here, as I mentioned, this is a tweet from an actual Chinese diplomat sowing some, interesting thoughts into the Twitter sphere. Who hates the Russians? Pipelines? The US. Who tried to stop them to be built? The US. Who said they would destroy them? The US did, actually. And who benefits from their destruction? Yeah, US and Qatar, we export a lot of liquid natural gas to Europe. Who destroyed them? No, the US didn't do it. It definitely wasn't us. Russians say, no, we didn't do it. It was definitely somebody else. Okay, let's see. We'll see. The point being that this is extremely useful propaganda. It's very divisive. It has a bunch of half-truths that you can link bite into. And it creates political inaction as it causes confusion. So this is very smart from China. And if you follow these Chinese diplomats, you'll be stunned at the kind of stuff that they're posting on Twitter, how aggressive it is, how polarizing it is. Be aware. And speaking of China, they had their issues with their in China, the economy is slowed down. Their COVID lockdowns have created havoc for the economy there. And at the same time, the US has been firm, and then members of Congress have all flown into Taiwan, get some dim sum or Ding Tai Fung, and then fly out. And China gets really upset. And then they basically, in August, while I was in Taiwan, if you guys remember, they did a blockade. They locked us down. Everybody freaked out. Well, I shouldn't say everybody, I freaked out. And they've never gotten so close. And if you see, this is Taipei where I was. We happened to have gone to the coastline with the kids for a little trip. And my wife definitely heard a couple of boom booms and kind of scared her. I didn't realize it was only like 22 kilometers away. They were in this area doing their drills, shooting missiles or blowing things up, and it's extremely close to mainland of Taiwan. Worrisome. I think that China needs to look tough because the Americans have kind of upped the ante. And also, this is probably a prelude to more blockades. If things get really bad, they could do this again, and they could do this for months if they wanted to. And that would definitely reduce the amount of flights and ships that come in and out of Taiwan, especially for those important semiconductors that are key to the world's everything. This could be quite troublesome. So literally, when we were in Taipei and they were doing these drills, all the fishermen didn't go out for fishing. So when we were at the markets trying to buy fish, there was just nothing left. Everything was low. So it was a very immediate reaction that we experienced while we were in Taiwan. Thank you very much, Pelosi. I've always speculated, and here's a drone shot of Taiwan soldiers on the island of Kingman. And recently, Taiwanese soldiers started shooting back. So this is, again, a little bit of an escalation. It's kind of crazy. This is literally, I don't know how it's so close. You can, what the Taiwan, our version of the Navy SEALs, our frogmen, their part of their training is to train in Kingman, swim across the water, go pick up a can of Coke from a local grocery store in China and bring it back. That was their proof of, actually secretly swimming over and not getting caught. That's how close Kingman is to the mainland of China. So yeah, this could be a hotspot and an easy target for China if they needed to do something kinetic and you needed a little bit of raw patriotism to go on in China. Other stresses in China, we said there was a huge drought. Three Gorges Dam is a huge source of power, but look, the water flow there is just dropped. So their electricity production has dropped. If we have La Nina and it happens again for them next year, they're going to have some other issues. Meanwhile, again, as I mentioned, COVID lockdowns in China, they're still a COVID zero policy country. They're still locking down big cities and just creating havoc. And it's this chart is really interesting. It says up to 35% of their GDP has been, influenced by these lockdowns. And the horrible part is you don't know when they pop up. You don't know when they lock down. That's random and very, very hard to plan if you're planning for anything, business, travel, etc. So it's very disruptive to their economy. And because of all that, also, the young people in China just have had a hard time getting jobs. So the youth unemployment rate in China is up to 20%, which is unheard of. And it's extremely unhealthy if you can't have a bunch of idle young people with no jobs thinking about what's wrong and causing social unrest. So this is a very, very critical thing for China to address. And if they don't get their handle on this could create other issues for social stability. Okay. So China has a lot of insecurity and instability going on this year. They have a big party congress October 16th in China. And their national, Independence Day, blah, 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 also around that time. It's expected that Xi Jinping will be elected for his third term. This is unprecedented because they had limited it to 2 before, and making himself chairman for life, so he can be the chairman of the Communist Party until he dies. These are big steps. There is pushback. There is unrest. There are a lot of things going on in China. So if these things get out of control, I worry that China has to take drastic actions, and they may direct that. Their favorite target is the US, but they may also direct that at Taiwan. And if they direct it at Taiwan, that could draw the United States and other allies to get involved. So risky hotspot. Overall, I think the chances of that happening are still low. I would say 20%. I've seen China bite their tongue and look longer term, but you never know. It's really a decision of a few men in power, and if they have a bad day and something blows up that we can't see, they could make those decisions. So be aware. Now, Europe has also suffered a lot, and they're going to suffer even more because they hooked themselves on Russian energy. They got addicted to it, and they couldn't get out of it. And now it's going cold turkey is extremely difficult, expensive. It's going to be painful. But the rhetoric now is changing. So they tend to be very diplomatic in how they talk. But now it's the war with Russia is a war about autocracy against democracy. And they're acknowledging that they should have listened to Poland and all these other people who's like, you got to worry about Russia, you got to worry about Russia. And they say, yes, we should have. And here, this is very, very inflammatory. The president of the EU is saying that, Balkans, Ukraine, Moldova, Georgia, you are part of our family. Your future is in our union, and we will not be complete without you. This is like, these are fighting words. There's no way that Russia is happy to hear those things, and this is ideological war, and it's a call to action for the European Union. But clearly, this does not make Putin and Russia feel better that they can negotiate some happy terms. In the US, we have midterm elections this November, and we've had a lot of issues. What comes to mind was the Roe versus Wade overturn that created a lot of emotion in the United States. And clearly that would be to the benefit of Democrats if more people thought that was the key thing, and that they voted for Democrats to help overturn that. But in reality, it looks like that the economy is still the #1 topic for Americans and probably for voters. And come November, I suspect that if headline inflation starts to rise again, if food prices and energy prices, gasoline prices start to rise again, and the unemployment picture worsens, and we're seeing that in the news almost every day. It's like, this company is saying this, is there a recession, et cetera, et cetera. We're getting so much of that news from so many different places. It's going to have an impact on the psychology and the faith of the average American. So this is going to be a challenge for the Democrats to do well, I think. Eventually, I think people just vote for change. And in this case, with the House and Senate, being controlled by the Democrats, there's going to be a vote to change that. And I don't know which. I think the House will flip to Republican, and the Senate has a chance to remain Democrat. But definitely there's going to be a vote for change this November. So talking about those headlines, you're seeing that from the big boys in the U.S. Corporations. Amazon closing call centers, closing warehouses. That's a big deal. They don't do that unless they're not dumb. They have 200 full-time economists working on this. They're seeing the future. They're saying it's rough. Let's cut costs. Let's, cut operations, cut staff. This is what they're planning to do. Walmart, Target, Kohl's, Under Armour, Nike, everybody is slowing down, cutting down inventories. They don't plan for a very robust holiday season. FedEx also told us doesn't look good, and they're cutting many things as well. Operations, warehouses, et cetera. So this is really interesting to me. So the forward earnings that companies and Wall Street tabulate, they're still pretty healthy. And I'm sure this is not up to date. I'm sure that's about to change drastically. I'm sure it's coming down. This green box, this gap between forward earnings and where the actual stock market is, they have to merge together somewhere. So likely that these forward earnings are going to come down significantly and follow the stocks, the S&P 500 down. Similarly, in Europe, over optimistic forward earnings, they're probably going to be turning down as well. And so we're seeing the earnings downgrades, clearly a big bump in Q2 with the earnings announcements. And now we're in Q3, and we're going to start in a couple of weeks, full-blown earnings announcements, and with that, all the forecasts. Some have early reported their forecasts, as I've shown you with, with Walgreens and with Walmart and et cetera, these type of retailers. But we're going to see those locked in, and Wall Street is going to adjust all those, and therefore they're going to adjust all their price targets for the S&P 500 lower. Again, we're starting to see that already. Inventory to sales ratio, when this is high, that means lots of inventory, little bit of sales, looks bad. Lots of inventory, they're going to not get any more new stuff, try to sell what they have, and if they can't sell it, they're going to start to discount it. So we're going to see as the months progress and we head into Christmas, probably if the economy is still really sluggish, we're going to see some nice discounts this year. Home builders, not feeling it, no surprise. Business activity contracting, no surprise. The evolution of Q3 forecasts from the Atlanta Fed, they started at 1.3 and they went down to 0.5, went down to 0.3. And then last week they said, no, we think it's 2.4. So I don't know. This is a head scratcher for me. I don't know how they do this. I don't know their model. It doesn't seem likely that we're going to see a robust Q3 GDP over the summer, except for the fact that everybody went traveling. But for the rest of the economy, a lot of things slow down. So we'll see. It may end up being positive somewhere, but I think Q4 will be extremely challenged to be positive. And then around the world, this kind of sentiment is just popping up everywhere. There are protests, civil unrest. We have a big one in Iran. This poor girl who didn't put on her headscarf correctly was apprehended by the police. And during detention, somehow she died. And that just triggered massive protest in Iran. It's been going on for now 3 weeks. And it's really shaken the establishment, the people in authority. And the people, let's not forget, they've been suffering years of sanctions from the US and the West. Their inflation is very high. The economy is very weak. This is building up. All of these things are building up. So it's a serious threat to the current leadership, the Ayatollah, and who knows what happens. But I do know that this filters on and influences other regions, as Iran is a strong supporter of Syria and Yemen, et cetera, et cetera. What happens when they're so busy at home with these issues, that they can't take care of, their homegrown issues. Similarly, in Iraq, big protests. There has been a small shooting war between Armenia and Azerbaijan, and Turkey is a supporter of Azerbaijan. Russia is a supporter of Armenia. India, I think they prefer Azerbaijan. Everybody's lining up on these type of things. And basically, with Russia being so busy with the Ukraine war and not able to really support the Armenian regime, what happens? It makes sense that this is a perfect time for Azerbaijanis to step in and take what they think was theirs. This disputed area, I don't know, it's pretty clearly surrounded by Azerbaijani sympathizers. Will they just take it? Possible. Will Armenians fight back for that? Could be. Will the Turks and the Indians get involved with this? All very possible. So globally, Russia, don't know. Who knows? Will they use tactical nukes? Will Putin be removed somehow? Don't know. If none of those things happen, I still have the long war scenario. I think he's going to wait out the winter and see if he can break the Europeans, break the unity there. Hungary and Serbia are very pro-Russia. They've been at loggerheads with the EU, and the EU now is getting more aggressive with their tactics. So does that create the division that Putin's hoping for? Don't know. But that's a risk that we have to be aware of. China, they're having a prosperity issue. They've hurt their own economy. The global economy is slowing. They have to do something to rebuild and regain momentum for their economy. If they can't do that, they might have to find a scapegoat, whether that's the US or Taiwan. Those are possible scenarios. Oops. Europe, it's going to be a horrible winter. A lot of people are going to suffer. If it's a cold winter, they're really going to suffer. I tend to say that they will remain united, with the possible exception of a couple countries, but overall they will remain united and hold steadfast. Strangely, the sabotage of the Nord Stream pipelines, well, it's kind of like burning those ships that Cortez did when he went to the New World. You have no way back now. They're not going to be rebuilt, and everything's not going to be easily redone. You bite the bullet, you hunker down, you focus, and move forward. And if Germany finally does this and pulls the rest of Europe along with it, it could be a very good uniting factor. US, we have our internal issues, but we're still the cleanest dirty shirt in the laundry pile. I think the Congress ends up being gridlocked, split by Republicans and Democrats. A gridlock US historically is desired by the financial markets because we don't get any new surprise taxes or regulations. However, there are a lot of issues, and if we do enter a long, hard recession, we're going to need our lawmakers to take effective action and make things better. So that remains to be seen. I worry that this recession is going to be long, not short, and could be deep. So we'll see. On the other side of that, the US is benefiting from all the war and conflicts around the world. The US dollar being so strong, yet our exports of all these things that the world needs, like weapons and food and energy, those are just filling up the cash machine for the US. And what the US will need to do as the next step is to rebuild, reshore, do all of that stuff. That's coming. It's not going to happen in Q4. It's not going to happen for half of 2023. But we're going to see Americans get industrious again. And we're going to see that energy come back in 2024, 2025. I'm fairly excited to see how that develops. So I think that's a really important thing to keep in mind for the long term. The Middle East, without Russia and now internal issues in Iran, the chessboard there is just getting shuffled. We don't know what's going to happen. If it gets out of control, it means supply shock to oil, and that could exacerbate inflation and global pain for longer. So that's the worry. Central Asia, China is aggressively reaching out and creating relationships with their neighbors over there, especially since that used to be the playground of the Russians, and the Russians are too busy to deal with it now. So China is actually benefiting from that, and they're taking advantage of that. So it was interesting to note Xi Jinping went off to, don't remember which country that was, one of the stands in Central Asia, and that's where he met Putin. He didn't fly to Russia. He met them somewhere in Central Asia in Putin's playground. And that was a power play, I think. And I think we need to take that as a signal that if China can regain its legging economically and keep its social unrest under control, strategically, that's going to be an area of focus for them to expand their influence. And then Latin America, we actually have a big presidential election in Brazil that's coming up, I think, in the next month or two. And everybody there is just dealing with high inflation, collapsing currencies, and then social and economic unrest. Don't really know what will happen, but as long as there's somebody fairly stable, specifically in Brazil, Brazil is a major exporter of energy and foodstuff, and that will help stabilize the world. So let's hope that those go well. Okay, so this is the summary of all the highlights I just have. Now let's look into my crystal ball. So to recap, I think 7% inflation still, headline inflation by the end of this year. Fed is raising interest rates to 4 to 4.5% by the end of this year. The inverted yield curve is going to stick around. Recession is likely. Dollar is going to remain strong, but it's going to trigger currency wars, which will cause probably emerging markets to have some kind of default or something bigger than that. Q3 and forward earnings are going to, Q4 forward earnings are going to be significantly adjusted in the next month. And that will set the baseline for where people think the stock market can end up. Unemployment, I think, will continue to rise, but not as fast as I think. I think it'll end up around 4% at the end of the year. But into next year, once it gets to around 4.5%, I think the Fed will start to, that's creating job losses in the economy, and people are going to get angry. I think the Fed will start to talk a little bit more dovish at that stage. Huge speculation. I think the Fed pauses interest rate hikes in Q1, but continues the balance sheet reduction until something breaks in the financial markets, or unemployment reaches 4.5%, or headline inflation falls below 5%. So that's just my guess. I think that feels about right. Okay. What does that mean for the markets? As I mentioned, global liquidity is draining, and it will continue to drain, and it's a leading indicator. And it could possibly cause something to break in a futures market, derivatives market, sovereign debts, or maybe a big leveraged private market. I don't know, but we're watching for that. I think the stock market has more to drop, where the S&P bottoms in this range around 3,400 or 3,000, with a market capitulation signal. Okay, and after market capitulation, historically, it's been a great time to go and buy stuff and hold it for a long time. So that's the game, that's the goal. So if we get a capitulation, I would say that's time to take some risk. Everybody's extremely bearish, high fear, This is the time where Buffett shines. He goes in with big dollars and buys excellent companies, uh, excellent stocks, and then he wants to hold them for a while. So I think that given that the US in general, we are the reserve currency, we have a strong military, we are the safe haven country of the world, we actually have abundant natural resources. We're in a special place and money will want to come to the US. So that will help the US stock markets rebound. Not just stocks, but any risk asset, including bonds and things like that. Having said that, the economy is not going to do well. We're due for this. The bankruptcy rates over the last 5 to 10 years has been extremely low because interest rates have been extremely low. People just have a way to go and borrow more money, even if their business is not running well. That's changing with higher interest rates, with lower liquidity. These zombie companies are not going to get bailed out. They're going to get sacrificed. And we're going to see more bankruptcies in 2023, maybe even some big ones, or other companies buying them up. But expect that this will be a tough environment, and this will likely push unemployment up faster. I think US Treasury bonds are going to become attractive again. I showed you that chart where they dropped almost like 30%, which is unheard of, historic. They're cheap now, and they provide stability. And if you're a big insurance company or a big pension company or a big corporate with extra cash, you're looking for stability in the storm. And Treasury bonds are AAA quality. The US country needs to default for these not to pay out. So that is going to become more attractive. I think a lot of retail investors are going to get out during the capitulation. And if they have any cash left, I think it just goes to a savings account, because by then savings account don't pay 0.1% anymore. They're going to pay you 1, 2, 3, whatever percent. And banks will do that to attract more cash. Critical commodities, I think, will rebound. Like I said, food, energy, those are needed. But also for the next stage, after we get in a depression or recession, it's always a cycle. Things will start to move again. People are going to see possibilities. And the easiest one to see is government policies. They said, we're going to build more semiconductors, bring them onshore. We're going to build this and that. That all means we need more copper. We need more industrial metals. We need rare earth metals. You can't build any of that stuff without these raw ingredients. And I think that will trigger some of the interest as supplies are still low. Potential demand is probably going to rise, especially if governments get involved to try to stimulate the economy. And I think that's a great opportunity. Okay. And then finally, I think the dollar, it has a cycle. It will eventually stop going up and will reverse at some point. I think that if the Fed pauses interest rate hikes, we could see the dollar maybe going sideways for a while in a range. But once the Fed starts QE again, once it pivots, once it starts to rebuild its the liquidity in the system, that is a likely candidate for when the dollar wants to start to weaken again. And also when risk assets start to look like they want to move up again. Okay, quickly, what does capitulation look like? Because this is really important. Nobody really understands it. I'm using the December 2018 example because this is the most recent example. I have this chart. I don't know if any of you remember December 2018, but the market just dropped like a rock. And it was a surprise because usually we can get a Santa Claus rally around there and it rebounds. This one dropped like a rock and people panicked. I literally had, clients call in and say, I can't take it anymore. Let's get out. That kind of stuff happens. What you see is a couple of things. You have to see these bars are volume bars, and red means selling volume is more than buying volume, which is gray. You see consecutive rising volume of sales before you get a capitulation, okay? And if you look at this level, this was a volume of around 5 billion shares. So sell, 3 billion, sell, 4 billion, sell 5 billion. Oh my God, I can't stand it. And then it peters out. So that precipitous volume increase and then the stock market dropping, that is historically what you would call something like a capitulation. And from there, if you market from there and just bought from there and just bought quality stuff and you bought it there and let it alone for a year or two, you end up positive. So that is something for us to think about. If we get a capitulation in the next months, it's a very attractive entry point. It's also the reason why we're keeping extra cash, because this capitulation could be soon. Okay. Sorry, geopolitically, this is my last crystal ball. All the elections, the world is shifting more right, more conservative, more nationalist. Sweden, Italy have just elected new leaders. They're all right-wingers. Okay. And I think globally, this is going to be the thing where selling protectionism to a suffering economy, the suffering people, is a pretty easy sell, and it gets you voted. Midterm elections, as I mentioned, I think it will be gridlocked. Republican House, Democratic Senate. Europe enters a hard recession. China is sluggish. All three major economies slowing at the same time. Unfortunately, I think there's still even more social unrest. We've seen a lot of protests. We've seen a lot of strikes and things like that around the world. Well, now winter's coming, and now shit gets real, and I'm cold and I'm hungry. That creates other desperation, and it could blow up. As we finish eating 2021 grain inventories, I think food prices are going to start to rise again, because this year's crop globally was not that good. Didn't collapse, but it wasn't that good. And if we have a third La Nina and we again have drought-like conditions for another year, 3 years running, that will be very devastating, because we won't have extra inventories much of 2022 food. And we're going to have even less inventory going into 2023. So that's of concern. OPEC and the energy, gas producing, oil producing countries, they're not interested in increasing production. And OPEC is a cartel. We know that. They designed this so that they can keep their prices up. Makes sense. But even outside of OPEC, the US is one of the largest energy producers in the world. Canada produces a lot. Venezuela, a lot of these other countries have it. However, at least in the US, we have very strong ESG policies. I mean, the government, if you go and look and follow the Secretary of Energy and just what she talks about, despite all the energy problems we're having, the high prices, their idea is just to get more money off the profits of these energy companies. That's what they would like. There's nothing that they do to incentivize producing more of oil or natural gas. So these energy companies have decided pretty much not to produce anymore. They're going to sit pretty, just rake in the cash. You might have to pay higher taxes, okay, but they're stable and they're safe, because the headwinds of these ESG policies really make it uninteresting and uneconomical for them to invest billions of dollars that need to be paid back over 10 years. That math doesn't work. And so, unfortunately, this disincentivization of energy production pretty much around the Western world, we're not going to see huge supply gains anywhere. And that will probably keep energy prices high for longer than most people believe. Okay. Black swans, take a look at these. These are all imagined. I don't know, but they could happen. A comet could hit the Earth or whatever. These are just some of my guesses of climate issues, war issues, natural disasters. They all will have significant impacts. This is only for you to just keep thinking about what ifs. Okay. So with all that I've just shared with you, now it's time to think a little about where we should put our money. So currently, full disclosure, I have a lot of cash, and I still have a lot of energy investments. I'm going to hang on to those even if they go down, because I think that they will rebound. But let's assume that we get a capitulation and we have cash that we can deploy. Where should we deploy that? My investment themes, my investment ideas in the short term, the most attractive is still cash flow generating things. So we know those to be the energy, the food and staples, utilities, healthcare. Okay. The dividend paying, or the companies that still have money to buy back their shares, those are financially, fiscally strong companies. So those are probably worth looking at. Again, similarly, energy, utilities, telecoms, healthcare, REITs. And then you have those just amazing quality fortress balance sheet stocks that a lot of them are big tech companies like, Apple or whoever. They're not in distress, even if their stock price drops or, interest rates go up and we have a recession. They have fortress balance sheets. So big tech, banks, energy, those are all kind of still really attractive. I think something does break in the next 6 months. I don't know what, but if you're smart enough, you probably want to hedge it or short it because there's an opportunity there. When I look a little bit longer term, out to 18 months, I stole this from this Wall Street guru guy, Zoltan, at Credit Suisse. I just like, you've heard me say these things, but I like how he worded it here. The rearm, restock, reshore, regrid themes. And rearm, that's pretty straightforward. The world is at war. We're using up all our bullets and bombs. We need more, better, cooler weapons. This is something that every country now is focused on. The US obviously is the leader here. China is no slouch. They're amping up all their skills and weapons and toys. But Europe now has to really think about this, as Russia is right there and they could deploy tactical nukes or just regular things and mess things up. They need more strength to defend themselves. Okay. Restocking of critical national security goods or critical industrial goods. You're going to need energy. You're going to need metals. You're going to need chemicals and semiconductors. We will have government support to do all of that. And we already have some government support to do all of that, to bring that all, bring the stock levels and then also bring them onto our shores or the shores of friends and allies. So the reshoring is going to require infrastructure, it's going to require land and industrialization. But this time around, there's going to be a lot more AI and robotics involved. So the new factories that are going to be built, they're all going to have all this stuff. As we know longer term, the labor force is probably still shrinking, okay? Especially outside of the US, in Europe, in Asia, the labor force is shrinking. The US is a little bit better than that. But having better robots and AI and factory controls is a hugely cost-effective thing to do. So this will be a major theme for us to invest in. Regrid is kind of, again, basically it's saying the ESG policies, climate protection, the electrification of the world will continue. And I think it will. And for that reason, anything ESG, electrification, batteries, the chemicals and materials needed for electrification, these are all long-term investments for us, or midterm investments for us. Longer term, we think about technologies. And I think the US has proven itself, the West has proven itself still the champion in healthcare biotech. It's to this date, it's amazing that China has ineffective vaccines for COVID, is part of the reason why they still have zero COVID policies. And this is a technological knowledge lead that the US and the West still has over China. I think we will keep improving this in the long term. In fact, we need to keep improving this. And luckily, with AI, with smarter computers and robotics, this could move quite quickly. So this is benefits the world, but the US and the West lead in this. So this is a great technology to invest in. As we mentioned, electrification of everything, you need the grid to be electrified, but then also once our cars and alternative energy become to a certain level, this will become global scales. I'm very interested in Web3 blockchain technology and linking that also with the future of augmented reality and metaverse. However, I don't know who's going to win in this space. It's way too early. There are big players, small players, and what gets adopted by the mass population, we still don't know. We don't know what that iPhone moment will be, but it's coming. And this is something that I think will be hugely important for the next 20, 30 years of economic growth. The US, we created the internet and we capitalized on the internet, and it drove our economy up for 20, 30 years just on that. This is the sector where I think it could become the next big thing. And please pay attention to those words and that news, and look for the technologies that might be winners in that. Okay. Whew. So I talked a lot, went fast, sounds scary, but don't panic. Be ready for market slowdown, economic slowdown. Be ready for capitulation. And then we're going to get back into the game, and we're going to invest for the future with those suggestions. In the meantime, keep yourself safe, keep yourself healthy. And if you have any comments or questions, don't hesitate to reach out and let me know. Hope you enjoy this, and stay tuned for more from me in the future. All right, take care. Bye.